Hello everyone, welcome to the video. This is going to be the most important video that I've made on this channel so far, and it's going to cover all the 10 key principles and rules of investing that I've used to build a portfolio of around 3 crores now. And these are rules that I have learned. Some of them I've learned the hard way by making mistakes, but these are the rules that I follow very consistently and diligently now. And these rules help me stay on track to my goal, which is to build 100 crores in equity investments, right? So my journey has started investing 2016, but it had started unfortunately with day trading, then swing trading, and then actively managed large cap funds. These are all things that I don't do anymore. And around my principles of investing, I've built these 10 rules. So these rules are going to answer all of the questions that have been asked on all of the comments in my videos, to be very honest. So it's going to cover end-to-end investment principles that I follow. Rule number 1 is do not trade. And what I mean by this is you have to invest for the long period of time. Now, who is trading for and who is investing for is a debate that has been going on in the industry. And some people say, okay, trading is good for the short term to make some money, when investment is good for someone who has a long-term horizon. I feel that trading is not good for majority of the people. That's just my opinion. I'm not saying that you should not trade, but for me, the personal rule is do not trade. Instead, what should you do? You should invest for the long time period, because that's when compounding really happens. That's when you're not stressed. You're not buying and selling, paying tax on every trade. You're not worried about what's happening this morning or this afternoon or this hour or this minute. So investment is what I really appreciate, specifically investing for the long term. And I am not saying that I've lost money in trading. I have done trading specifically during the period of 2020. I did do trades, and there was a time when I actually needed the money because of the pandemic. There was some work that I had to give up. I had some Airbnbs which stopped generating revenue at that point of time. So there was a time when I actually traded. I made around 15.86 lakhs during this time period. In total, I realized 16.44 lakhs. I needed a lakh a month to sustain my lifestyle during the pandemic. And this was also the time that I got married. So it was important for me to have the cash, and I actually got it from trading. So I'm not against trading. I'm not saying that everyone who trades loses money. This was all swing trades that made me this 16.44 lakhs. But eventually this was the last time that I ever traded. After my marriage, I wanted to focus on my relationship. After that, I became a father. I wanted to focus on my daughter. So eventually, what I wanted was time and freedom. It's not the fear of losing money, but the ability to gain time and freedom, which is what got me out of trading. And I made this a rule to never trade again. Now, the important thing to understand here is that most people who are talking about the problems with trading are talking from a loss aversion mindset, that they don't want to see the loss in their portfolio. They don't want to see the loss in their trades. That's not the point I'm coming to you from. So you have to understand that my point is how do I increase my time and freedom, and not that how do I avoid the loss or avoid losing money. So this is an important difference to understand. Because whenever someone says you make loss and hence you should not trade, you can always say no, but some people do not make loss. That's not an argument I'm going with. What I'm saying is that you will have full freedom of time and energy, and you'll have ability to do so much more and experience real life, because guess what? Real life is outside of all of those charts, in my opinion, right? So I don't want to look at stock charts. So I do this to gain time and freedom. Rule number 2, which very nicely follows my chase for freedom, is invest passively. So I always do passive investing. What I mean is I am typically investing in ETFs, index funds, and in some cases mutual funds. We'll come to that. But I don't buy individual companies. In fact, individual companies always will make less than 20% of my portfolio, and that's my satellite portfolio. So there's a core portfolio, which is 80%, and then there's a satellite portfolio, 20%. That 20%, I could take a risk. I could buy an individual company, but I would do that only with 20% or less of my portfolio. And currently, I think it's even lesser than 20%. But that's my rule when it comes to buying companies or researching companies actively. So it's not to say that I don't buy individual companies, but to some extent, I haven't bought an individual company in the past 2 years. So that means that I'm not actively investing. I'm not actively looking for which company is going to have a bull run, which stock is going to grow. I'm not looking at that. And because of that, I don't have to research companies. So these are some of the companies in my holdings, and honestly, I do have some of these companies that are doing well, and some of them, for example, Hindustan Unilever is not doing so well, but I don't care. I don't know what Hindustan Unilever is doing. I bought this long time ago. I don't know what it's doing. I'm going to probably keep it for a few years and not really care about what it's doing. So that's called passive investing. And if you look at my overall portfolio, these companies don't even show up in my top 5, 6, 7 holdings. So these are my top holdings right now. So the first one is Midcap 150, which is an ETF of the Midcap 150 companies. Then I have Nifty Next 50. So this is an ETF of the next 50 companies. So company number 51 to 100 in the Indian market. And then I have the top 50 companies, which is the Nifty BCTF. Those 3 alone are holding around 1 crore of my money, right? And this is just my portfolio on Kite. I also use Coin for my mutual fund investments. But these 3 are all passive investments, right? I don't have to research any company. My 4th holding is NASDAQ 100, which is around, usually I try to keep it at 10% of my portfolio, which again is a passive investment. Then I have the gold ETF, which is 100% passive investment. Then I have the consumer ETF, which I bought many years ago. And I just did not plan to sell it because I personally like consumer companies, but I don't really care how the consumption index is changing over time, because I know overall, as India grows, the consumption index will grow. So I don't need to look at charts on a daily basis, right? So think about freedom again. This is an index from China, which is not doing that well, right? The Hong Kong index, which I bought many years ago. I may not have made that decision today to buy it. And, I'm actually waiting for this to show up in green someday, luckily, and then sell it off. But I don't care if it's sitting there, right? So now we are talking about these small companies, small investments. In my portfolio split, anything less than 5 lakhs is something I'm not really worried about. I'm not losing my sleep at night for anything that I've invested like less than 5 lakhs. Like that's my rule, right? So Bajaj Auto, Tata Power, L&T, Hindustan Unilever, Tata Motors, and then silver ETF to get exposure to silver, which is also very passive, and then Tata Consumer. Like these are companies which I don't have to worry about because they're, again, huge companies. I just personally have some sort of liking for these companies, which is why I have them in my portfolio. Then I was actually actively researching companies, but I haven't done this for 2 years. And someday I might just wake up and decide to get rid of all of these companies and just put that money back into the index, right? Back into the Midcap 150, Next 50, Nifty 50. It could happen anytime, and I'll make a video on that. But what I'm trying to say is my stake in individual companies is so less that it's just the satellite. It's not my core, so I'm not worried about it, right? So this is the core and satellite concept. So your core portfolio is really the heart of the portfolio. This is where you have your long-term investments. You have the best-in-class assets. Typically, index funds is what I prefer. My vehicle for my core portfolio is index funds. And then we have the satellite, which are all of these different kinds of games that you want to try out, because it's also about having fun. It's not just about having your wealth being preserved. That's the first step. Your wealth growing is the second step. But the third step is, okay, maybe you want to try something experimental. That's all what the satellite portfolio is for. Now, I don't use the satellite portfolio that much, but if I wanted to, I will make sure that I only do it with 20% of my portfolio, right? So this brings us to rule number 3, which is do not follow market news or stock advices. This is so important because this is a distraction. When you have an app like Money Control or Live Mint or whatever, these are good apps, but fortunately none of them sponsors me, and I'm not sponsored by any company, which is why I can actually say that you should delete all of these apps. You should not look at the news. If you're following people who tell you which stock is going to go up, you should unfollow all of them on YouTube, right? If you want to actually unfollow all of personal finance advice, watch this video till the end and then just unfollow me as well, unsubscribe. Most influencers are asking you to subscribe. I'm asking you if you've learned enough and now you know the path, you just want to put in your money and let it consistently compound. Stop listening to advice on the internet, because the more you listen to advice, the more you get new ideas about this company, how did this company do this morning, and so forth. The more you're stuck. It's a loop, and they want to keep you stuck because that's how they make money. But what happens to your personal life when you do that? This is what happens, right? So I don't want to be that father or that husband who's looking outside of my working hours. I do like working on my core business, but that's a limited number of hours. Usually that's 5 to 6 hours a day. That's the extent of how much I work. On Saturdays, I schedule 1 or 2 hours to make some videos, right? And that's what I'm doing right now. And then it's taken care of by my assistant. He would upload and make sure that the thumbnail looks good and put it up on YouTube. And those 2 hours that I allocate on Saturday, I would spend probably an hour to record the video. And I'm just sharing my journey, so I don't really have to do a lot of research. It's just things that I know and I want to share with everyone. There's a little bit of research that I would do if I need to figure out specifics of a point that I'm talking about. That's mostly something I do with ChatGPT, so it doesn't take that much of a time. And probably 30 minutes to 45 minutes replying to comments, just seeing what kind of ideas people want me to make videos about. That's all about it. And YouTube is not my business. I don't think it's a business. I don't see it as a business. Will it make money, and will I say no if it makes money for me in the future? Probably not. But will I see it as a business? No, I see it as a hobby because I don't want another business stress. I have a very good business that I focus on, which is my digital marketing agency and digital marketing consulting. And that's where I want the business stress. I do want the business stress from that business, but I don't want the business stress from YouTube. That's why YouTube is a hobby, right? So these rules will help you not be this father or not be this husband, right? So what should you do instead? Instead, you should invest in the market and then forget about the market. That's the number one tip if I had to give someone. Invest in the market and forget about the market. That's exactly what index investing is. You just basically buy the market and then hold it forever. Okay, let's come to rule 4. Before you start commenting about tax, we will come to that as well, right? So rule number 4, do not try to beat the stock market. And the reason for that is this is not your personal goal. Just think about what your personal goal is. Is your personal goal to beat the stock market? Is that how you will find fulfillment in life? What does that have to do with anything in your life? So what are your goals? Maybe your goals are to preserve your wealth, to grow your wealth, to beat inflation. Those are all potentially good goals to have, to grow your income, maybe to grow your money, maybe to invest in places where you can get a very high return. That's also a very good goal. But it has nothing to do with beating the stock market. The stock market is just a fantasy. It's just Maya, right? It's just some number. So why do you have to beat the stock market? Maybe the stock market returns 1% in the next 1 year. Would you like to return 2%? Probably not. Like my personal goal is to get to an XIRR or stay at an average annual return of around 15%. Will that beat the stock market? I don't care. Maybe the stock market is returning 14% and I'm beating it by 1%, and it's okay, because I don't really care about the stock market. Because once you chase a goal which has nothing to do with your personal goals, that just becomes something that will lead to more distraction, because you'll start finding about videos about how to beat the stock market. But that has nothing to do with your life. You just have to set your own goals. It could be financial goals. It could be return goals. It could be that as well. It could be goals to generate cash flow. It could be a systematic withdrawal plan that you need. It could be retirement, whatever your goals are. Focus on your goals instead of beating the stock market. For me personally, I don't want to beat the stock market because that just creates unnecessary stress, has no alignment with my personal goals and values. Instead, what do? Spend time on the beach, spend time with my daughter. I love doing yoga. I do a lot of yoga, exercise, cardio. These are things I enjoy, So I'd go hiking with my daughter. I'll go to the beach. I'm spending a lot of time with her these days, and I'm generally allocating time on my calendar outside of my business to make sure I have this family time with my wife and my daughter. And those are the personal things that really bring fulfillment in life, right? Rule number 5, very important. Now we are coming to the investment, to the meat of the content, right? So do not invest in actively managed large cap funds. And I've made this mistake from 2016 to 2017, I think, before I did enough research about investing. Now I do not invest in any actively managed large cap funds. 2 reasons. One, they over a long period of time, they do not or hardly beat the index funds. And second reason is that they charge you a higher expense ratio compared to index funds, which have a very low expense ratio. So you'll be tracking the index, you'll be much better off in terms of returns, plus you'll be paying less in expense ratios. So that brings me to the point of actually making it senseless to buy actively managed large cap funds. So what do you do for large cap funds? You pick index funds. So I've shown you my portfolio. I have the Nifty 50, I have the Nifty Next 50, and I have the mid cap 150 as well. We'll come to mid cap, but let's focus on the large cap for now, right? So Nifty 50, Next 50, those are 2 different. Why do I take them differently? Because I want to split differently between the Nifty 50 and the Next 50. Okay, I don't want a Nifty 100 fund, which mostly will put my money in the top 50 companies and not so much in the next 50 companies. That's my problem with the Nifty 100 fund, which is why I pick a Nifty 50 and a Next 50 separately, right? So for large cap investments, I only do index funds or ETFs. By the way, there's a lot of comments about index funds versus ETFs. I have a separate video on this, but by the way, guys, just pick the one you like. It doesn't matter. If you can be disciplined and consistent with an SIP, which most people I think would be better off doing, then just pick an index fund. You don't need an ETF. It's just exactly the same thing, right? So your money is going in the same companies. You might pay a little tiny bit more expense ratio with an index fund of the same ETF, for example, a Nifty 50 or an X50 fund. And if you pick something with a low expense ratio like an ICICI, again, not a sponsored thing, but you get low expense ratio, good tracking, very low tracking error, you'd be better off because you'll be running an SIP there. Unlike me, where you have to go to the ETF, either run an SIP through Kite, which is an option in Zerodha. I don't know if it's an option in other platforms, again, not sponsored. But you could just do an SIP in an index fund. You don't need the ETF equivalent of that. It's the same thing. The point is not to go for an actively managed mutual fund for large cap investments. That's the most important point. I see there's a lot of distraction in the comments on the YouTube section because people are trying to find, okay, what is the difference between index and ETF? Why do you do ETF and why should I do ETF? I'm saying, no, you should not do ETF if you don't want to do ETF. If you want to do index fund, do index fund. I'm not even saying you should not buy actively managed large cap funds. What I'm saying is, this is my rule. I do not invest in actively managed large cap funds, and I'm explaining the reasons why. This is for educational purposes only. And if you can learn from this and then apply it in your life, I'm not going to stop you. But this is not personal finance advice. And this is not a disclaimer to avoid any SEBI issues, because I'm not trading. I'm not talking about stock markets or what you should buy. This is because you might lose a lot of money just because your distributor or fund manager or someone asked you to invest in that particular actively managed large cap fund. And that money that you're losing will also compound over time, right? So index funds for large cap investments. Rule number 6, do not invest in small cap index funds or ETFs. This is very important to put it out because people think index investors are only about index investing. By the way, I call myself an index investor because I have majority of my investments in index, but I am by no means an index investor in small cap funds. For small cap, I do buy actively managed mutual funds. In fact, that's the only way I invest in small cap is through actively managed mutual funds. It's so important to understand that you cannot just fit some person into one category. Okay, this guy is an index investor. The only thing he buys is index or ETFs, nothing else. That's not true, right? There's a lot of things that I buy that I don't talk about here. What I'm talking about here is my equity portfolio in India. That's all I talk about on my YouTube channel here, right? So tomorrow I might show you something else. Like, for example, recently I made a video about my Airbnb portfolio, right? So you can't put a person in one category. What you need to understand is, what are the best things that I can learn from this person's journey? And once you've got a summary of that, you can then start to collect all of this information that you've got from different people and build a simplistic version of strategy for yourself. And my channel, we're all about simplifying things. So what I'm trying to do is simplify investing. So these rules are what guide me to simplify that process, right? So do not invest in small cap index funds or ETFs. Why? It's a huge universe. Many actively managed small cap funds, in fact, most actively managed small cap funds that are good funds, will beat the index, will beat the small cap index. So this is exactly the opposite of rule number 5. Rule number 5 was, do not invest in actively managed large cap funds. Instead, buy the index fund. For small cap, do not invest in index funds or ETF. Instead, buy actively managed small cap funds. And when it comes to mid cap, I do a combination of both, right? So I do the mid cap 150 index, but I also have one actively managed mid cap fund. And if you can guess which fund that is, I'll be stoked. So leave a comment just guessing what is that one single actively managed mutual fund for mid cap category that I invest in. And if you guess it correctly, there is a small surprise. So I have a gift for you if you guess it correctly. So leave that in the comment, and I'll comment and I'll reply to you and I'll give you the gift. But instead, pick the best actively managed small cap fund, right? So that brings us to rule number 7. Now we've discussed how to invest in large cap, mid cap, and small cap. And you've also seen my portfolio, at least on Kite. So how do you create your overall portfolio split? Here's an example. Here's my investment split. So again, on this channel, I share with you what I'm doing. So my equity investing split is 30, 30, 30, 10. 30% in large cap, 30% in mid cap, 30% in small cap, and 10% international exposure, which I'm typically getting through NASDAQ 100 and S&P 500, a combination of those two, right? So this kind of split, if you create, then you can keep adjusting or rebalancing your portfolio. Let's say once a year or twice a year should be sufficient to make sure that you're managing this kind of a split, because your large cap exposure will give me a lower risk, but it's going to be a safer investment, and over time it's going to still grow as the Indian economy grows, which is the main thing that I'm betting on, right? And I think it's a very safe bet to bet on. India is a very safe bet because India is going to grow. There's just no doubt about that. 30% of mid cap exposure, 30% of small cap, because there's good potential of growth, but then you're actively picking those through an actively managed mutual fund. For you, it's still passive, but for the fund manager, it's an active investing. The 30% mid cap, you have a combination. Like I said, I have the mid cap 150 index, but I also have an actively managed mutual fund, which I asked you to guess. And then 30% is all indexed in the large cap. So you see how you go from the larger to the smaller companies. You switch from a more passive to a more active investing. That's the beauty. Because the more smaller companies, the bigger the universe, the bigger also the chance of many of those companies failing. So it's important to actively pick those, right? And then the 10% is the international exposure. Rule number 8, SIPs for mutual fund investments to automate investing. So a lot of people thinking, oh, this guy is ETF guy, index guy. But look, I have approximately contributed 2 lakhs in SIPs this month. So I am definitely keeping myself disciplined with SIPs. Do I do lump sum investments? Yes, I invest every month manually in ETFs. I don't consider them lump sum because I do it every month. Are they manual? Yes. Are they automated? No. Is there an option to automate them on Kite? Yes. Do I use that option? No. So I'm answering all of your questions in this video, right? I enjoy the process of taking money, putting it into the index based on my portfolio split manually. I just enjoy it. It's the least logical answer that you would expect. I enjoy that process, so I do that. Now, when it comes to SIPs, now you can blast me on the comment section, but that's, it's fun for me. I enjoy that, right? Now, coming to the actively managed small cap funds, like I said, I have small cap funds. You can see that I have an SIP right here, and you can see the name of the fund as well. I'm not going to shout it out because they don't pay me for it. And even if they did, probably I'm not going to shout it out. Like I said, YouTube is a hobby for me. But you can see that I have 6 active SIPs. It's close to 2 lakhs a month that I've contributed this month, right? So don't think of one person being an index investor can never invest in an SIP mutual fund. I've been running SIPs for as long as I've been investing. It's outlived my index investing. Index investing is something I've been doing for lesser number of years compared to the SIP investing, right? So this is what automates discipline. This is why I like it. Rule number 9, do not sell. So the tax army that keeps coming on my YouTube section, we don't want to pay tax. That's why we don't want to make money. And that's why we don't want a 100 crore portfolio like you. That's why we want to stay poor or whatever. Anyway, don't fear tax. However, there are strategies to not sell. And that's my rule number 9. Do not sell. Okay. This is a buy, borrow, die strategy. I haven't, died yet, so I cannot tell you how well this works. But this is a beautiful strategy that a lot of wealthy households and families and holding companies of personal families and personal offices use, where they buy assets, borrow against the assets, and then die, right? And in many geographies, when you die, you can pass it on tax-free to your next generation. In some geographies, you cannot. In some cases, you can build a family trust and then pass it on to that. In some cases, you may pass it on to the next generation and they might have to pay 10% tax. And guess what? They're not going to be angry at you for giving them 100 crores and making you pay 10% tax if, they have to. But the point is that buy, borrow, die is one of the strategies, though I cannot speak a lot about this because I will only know once I die, right? And that's the time you won't see a video from me. But even if you do, even if you sell, even if you have to sell, maybe there's a situation where you have to sell, don't stress so much about tax. I am really concerned when people are stressed so much about the long-term capital gains tax. I don't know what, the 10% or whatever. They're so stressed about that it just seems that they don't want to make money or they don't want to invest because they have to eventually someday pay a 10% tax. And I know that people will again come back and comment, when you make money, you have to pay 30%. When you take the money to your personal account, you have to pay again personal tax. When you take that money to, hey, come on, right? So First of all, as you get rich, you'll understand how to work around tax. You'll understand how to, the people who are really, really rich, they complain about the tax the least, and that's because you can become a business owner. You can show expenses. Tax policies are way more bendable when you think about being a business owner versus when you think about being an employee, right? So you have to be smart. You can't just say I'm stuck being a freelancer and I have to pay tax. Why not? You can incorporate a company, become a business, and now suddenly every flight ticket that you take to meet your client from your hometown is an expense to the company. You don't have to pay tax on that. So again, not going to get in that discussion, but even if you pay like crazy amounts of tax, don't stress about it. One of the reasons why I moved and incorporated my company in Singapore versus India is to save on tax, and I have a separate dedicated video about how I did that. So you take the necessary action to work around the tax as much as possible. You learn about new strategies. Do all of this instead of commenting on YouTube videos, complaining about the government, complaining about the tax, because there's not much that will happen. And this is why, even though India is a very productive country, there's a lot of loss of energy in distraction, in these kinds of comments, and wasting energy in these outlets, right? So instead of that, learn, grow, implement new strategies, see what works for you. Number 10, the final rule before I retire. Just kidding. Final rule is to build passive income sources which will equate your monthly investment amount before you leave active income. For example, my personal goal is to invest 2 lakhs a month. If I have to invest 2 lakhs a month, I have to build passive income sources, at least income sources that need less of the active investment, because there's actually nothing such as like 100% passive income. So there's a spectrum of active to passive, and there are different revenue sources in that spectrum. I can make a whole new video about this if you guys want. But from that spectrum of being most active to being least active or most passive, there are many different revenue streams. So over time, I'm going to reduce my active income streams and increase my passive income streams until my passive income sources equal to that 2.5 lakhs of revenue a month. And that's when you could actually think about completely leaving your active income and just doing whatever you want with your time, right? So that's the final rule. And I want to end it at this because a lot of people are chasing this time when they would be able to retire. And it's honestly something that I've also spoken about on this channel, but more than the FIRE number or, the lump sum, because that's for a very few people, where they'll be like, okay, today I have 100 crores and I can retire, or today I have 50 crores and I can retire, today I have 25 crores. I don't know what your number is. That's also cool. But another way to think about that, for me, this is my rule, is to equate my passive income sources to the monthly investment amount. So I'm making that much money that I can then invest monthly, that much amount, after taking care of my expenses, right? So that's what I want to leave you guys with. And that's all for this video. Those were my top 10 rules of investing. I hope you loved them. One more thing I would love you to do is just leave a comment on which rule you like the most, because once I see those comments, whichever rule people like the most, I'm going to make a separate individual video about that rule and explaining that in detail. So thank you so much for watching. I'll see you in the next one. Bye.